Welcome to this special year-end episode of the Michael Yardney Podcast, where we like to help investors get clarity amongst the confusion of all the mixed messages regarding the property markets so they can develop the financial freedom they're looking for. And as our property markets close the books for another whirlwind year, I've got one of my regular guests with me today to help make sense of it all, Stuart Wemyss, founder of Pro Solution Private Clients. Stuart isn't just a trusted voice in finance and property, but he's somebody who always manages to cut through the noise with practical, no-nonsense insights. And that's obviously based on his many decades of experience in the property markets. So today, together, I want to review what happened in 2024, what shaped the market, and I'm keen to get Stuart's perspective to help us unpack what 2025 could mean for Australia's property markets and economy as well. So let's get into the show, learn some lessons from 2024, and see what's ahead for 2025.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Stuart.
Hey, Michael. Thanks for having me back again.
Now, let's face it, 2024 threw plenty at us as property investors. The interest rates, the geopolitical turmoil, falling consumer confidence, uncertainty about what's going to happen with our markets and interest rates, shifting buyer behaviour, and the housing market that continue to keep us as investors on our toes. So, Stuart, I'd like to take stock of some of the lessons that the last year taught us and see how they could shape the road ahead. Looking back, how was 2024 for you?
2024 for me personally, and from a business perspective, has been great. You know, I don't really care what the market does over the next 12 months, and certainly I don't care from a personal perspective or a professional. So that is for my clients, my decisions are based in terms of decades rather than years. But it's really interesting if you cast even a wider net, Michael, and look at what's happened over the last 5 calendar years, which sort of takes in sort of just before pre-COVID, I guess, and that whole situation. You would have to conclude, as someone that follows property, is that no one really knows what's going to happen. Like, if you think about all the forecasts and the commentary over that time, the vast majority, like more than 90% of it has been outright wrong, like it has been poor. And that's not a criticism necessarily of the forecasters, because, you know, who could have predicted some of the stuff that would happen. But I guess what it reminds us as investors is, you know, focusing on the long term means you don't have to work out what's going to happen in the shorter term.
Oh, I agree with you. I think it's much easier to make 5-year or 10-year forecasts than it is to make 12-month forecasts, which the media is asking you and me to make at the moment. And they don't like it when you're not going to tell them what's going to happen. But when you actually see how the very big economic houses, the banks, even the Reserve Bank has got their forecasts wrong, it makes it almost foolish to try and understand. But having said that, as investors, we still would like to have some certainty about what's going on. So were there any particular surprises in 2024 that caught you off guard?
I think there was one in particular, and it probably shouldn't have caught me off guard, which I'll come back to in a second. The surprise was, I mean, at least as I read it, is that the tightening in borrowing capacity and the significant increase in interest rates really changed a lot of people's investment decisions, or had an impact on people's investment decisions. And frankly, it's, you know, that they were forced into that situation to change. So what I mean is that anyone that was contemplating making an investment, say in 21 or 22, might have had, for argument or for instance, a borrowing capacity of $1 million. Anyway, and they might have ummed and ahed how they're going to spend that $1 million. But when they came to implementing, or if they delayed implementing until 2024, they probably would have found out their borrowing capacity is now $600,000 or $700,000, you know, a significant reduction, mostly as a result of much higher interest rates and therefore a higher benchmark rate. And so I think the consequence of that compression in borrowing capacity meant that the more affordable markets did much better than the more expensive markets. So I'm really obviously referring there to Adelaide, Perth and Brisbane.
Yep.
Although, there's a lot of work I've done previously that shows that there's a very strong link between money supply, which is obviously, how much people are borrowing, and property price growth. So really, if I put myself back at the beginning of 2024, I probably should have realised that a compression in borrowing capacity will mean those more affordable markets, whether that's regional over capital city or whether it's, Adelaide versus Melbourne and Sydney. I probably should have realised that that was going to be a consequence, or that's how it was going to play out this year.
I think there are a couple of other factors that contribute to that, Stuart. First of all, the upper end of the markets in Melbourne and Sydney in particular, the more affluent areas, they just held steady for a while. People weren't moving house at the upper end of the markets. They were just wanting to see how the year would pan out. But I think the Perth and Adelaide markets in 2024 and even the year before were very much driven by a new wave of buyers agents who were now, it's not just buyers agents and investors that drove those markets, but they were a significant factor. People buying there very often sight unseen from buyers agents who weren't licensed in those states, pushing up values much higher than the locals thought the properties were worth.
Yeah, look, that's right. And the other thing I would say, Michael, is kind of interesting is that if you look at the rhetoric around Perth for the last 10 years, a lot of people look at that market and go, oh, it's too closely tied to mining. Well, if you look at the commodity price index that the RBA puts together, it's dropped 24% this calendar year, and yet Perth has taken off. Now, that's not to say that somehow Perth is decoupled from the mining sector. That's not what I'm suggesting. Of course, that's the largest employer, and of course, it's going to have an impact. But I guess what it teaches people is that property, and this is why I think a lot of economic forecasts are wrong, is because property is so multifaceted, and 2/3 of buyers are owner occupiers. And they aren't necessarily driven purely just by financial implications as well. So that's why property is so hard to predict, I guess, in the shorter term. The thing about investors moving markets, I think I've got this thesis, and I really need to dedicate some time to sort of pull apart the numbers. My thesis for Perth, for instance, because it's a good example, is that you've had no price growth for 15 years leading into mid-2023. All of a sudden, so really no price growth means that my ability to upgrade my home is solely reliant on my ability to reduce debt, which is all linked to income or wealth effect, all those sorts of things. Whereas we know that, and I certainly know from experience, that you do, to upgrade your home, you do sort of rely on some price appreciation as well. So what's happened is obviously investors have come in to say, okay, now Perth's cheap, my borrowing capacity is lower, let's go to Perth. And so there's a sort of herd mentality there, because once it becomes popular, everyone wants to jump on the bandwagon. But I would argue that investors probably move markets out of a flat cycle into a growth cycle in all situations. And the reason for that is that there's probably a lot of pent-up demand in Perth of owner-occupiers wanting to upgrade, but they're not able to because they haven't had any growth for 15 years. So sometimes people point to, say, Perth or other markets saying, oh, it's investor-driven. Well, I mean, it's true in this cycle. Yeah, certainly investors are having a significant impact on prices in that location, but there still is an underlying level of demand from owner-occupiers and from people that live in Perth, which is critical because Perth, or people are always talking about interstate or East Coast investors, but that will come, and I think that's a natural part of the cycle.
Well, Stuart, you were saying it's a thesis, I believe, while you can't prove it. In fact, I'm sure what you're saying is correct. owner-occupiers underpin the market, and they're a very important part of it. And it's investors who create the booms or start them off, and also the downturns, because they're more short-term focused. They buy with their calculators rather than their hearts, like owner-occupiers. But owner-occupiers in Perth, and we've both got clients in Perth, see all of a sudden seeing the markets moving on. So now is the time to get in and take advantage and upgrade. And so that makes sense. And Perth was clearly undervalued because wages in Perth weren't that different. We're talking about Perth, but it's much the same in Adelaide. I think so wages weren't that much different. So therefore, houses were affordable there. I think Brisbane's got some other fundamentals though. So Brisbane's also done not as well as Perth and Adelaide, but it's actually performed strongly in the short term, and it's got the long-term fundamentals of the Olympic Games only 8 years away, that are going to just create more people coming into the state, more infrastructure, things that are going to be good in the long term. So we know that the Olympic Games, Commonwealth Games don't do a lot at the time they happen, but they do a lot for the state and for its, it'll be well known around the world when the time comes. And that'll be here sooner than we think.
Yeah, I had the displeasure of going to Brisbane last week, in fact, Michael, and the airport was chock-a-block, like unbelievable how busy that airport, and it's anecdotal evidence, of course, not really that meaningful in of itself, but yeah, I think there's a lot of strong fundamentals in that Brisbane market, and, I think there's a lot to go. There's a lot to go in terms of future growth.
So when we talk about surprises for 2024, I hear what you say about finance. And I think the fact that interest rates didn't drop has also added to that, and that APRA haven't made any difference to their buffers. One of my big surprises was the underperformance of the Melbourne property market. We didn't think it was going to perform as strongly as the other states, but I guess there are more issues in Melbourne than I expected to affect local consumer confidence, even though it seems like it's going to be the place a lot of people will invest next year.
Yeah, well, what do you say about Melbourne? The government released their data for the 24 financial year last week, Michael. You would have seen it, that they've increased payroll tax and land tax by more than $4 billion from 23 to 24 financial year. So they've essentially ripped $4 billion out of the economy and then contributed to God knows where, either servicing debt or more infrastructure projects. But, it's not good news for the economy, of course. And we don't have, there's not a state election until the end of 26 in Melbourne. So there's a long way to go under this current government to give what I think investors need, which is some sort of certainty that, these changes, that tenancy laws won't be changed further, that things won't get more challenging. So, maybe there's a little bit more pain to come for Melbourne. But, the good thing is that the clearance rate has hovered around 60%. Now, I'd be interested in your comments here, Michael, because I'd imagine there's probably more private sales than auctions at the moment, in a less buoyant market. Sometimes selling privately is a better sales process than auction. But I was, to be honest, expecting the clearance rate to trend towards low 50s. So I think the market's actually held up pretty well.
Well, a clearance rate around 60% isn't the level which would push property values up, but it does show there's depth in the market. And every weekend at the end of this year, there's been well over 1,000 auctions in Melbourne. And again, not everyone sells at the time, but I think that if you look at where they've been spread, there hasn't been as many in the more affluent eastern suburbs or the affluent southeastern suburbs. It's been more the middle ring and the cheaper suburbs that, as you said, are the ones that performed well over 2024. I guess another trend that I noticed in 2024 was more investor bashing. The media particularly like to demonise property investors, Stuart.
We were having a conversation about this today, about social housing versus private rental properties. And the disrepair that social housing is in, and the terrible condition that the poor occupiers of social housing have to put up with. And so the government's very quick to point their finger at private landlords, but they're not looking in their own backyard in terms of, how they're maintaining their own properties for, very vulnerable section of the community. So, but I
can
think
just make that clear. What happens is if you or I, for our rental properties, don't meet minimum standards, we don't just get a slap over the wrist. We get significant fines, and property managers also get significant fines. That doesn't apply to government housing, does it?
No, and look, I'm not going to sit here thinking that life is fair and what's good for the government is good for the people. But I think it deserves a little bit more attention. And to be honest, from a welfare and just a moral perspective,
Yep.
the government should definitely be doing the right thing in that space, or at least doing a lot better than what it is doing. And certainly before it starts throwing stones at private investors. But stock supply is an interesting one, isn't it, Michael? Because you look at the aggregate figures, you go, okay, supply in most markets isn't too bad. But I would say, certainly in those buoyant markets, so Brisbane, Adelaide and Perth, really difficult to, find a good property to buy because there is so much demand there. But I'd also argue in the slower markets like Melbourne, still it's pretty challenging to find good stock in
Good
terms of
stock.
good
That's the
quality
difference. Yes.
property. And I think what that shows is in those good areas in times of slowdown, and you and I have seen it many times before, the people that own these good quality properties just won't sell. They'll ride it out. They've seen it all before. They've enjoyed the capital growth. So sometimes that skews figures too. I know that we've got very large data set. But sometimes it skews results as well because people are selling kind of secondary property or impaired property in different locations. And the really good quality AAA property tends to not trade very much during these periods of time.
It doesn't. Having said that, there's been more building approvals in Victoria and Melbourne in particular than other states, and more new houses being built despite all the challenges. Interestingly, there's more stock on the market, and people say all these listings, that's what's holding property values down. Not true, because in fact, most people putting their properties on the market, as you said before, are owner-occupiers, and so they're going to upgrade, downgrade, right-size, move house. So most sellers are also buyers in the market. I think in these more challenging times in Melbourne, they've just been wondering, should I buy first or should I sell first? The uncertainty of buying something and then not being sure what you can sell your house for has held some people back.
Yeah, I mean, that's right. It's always hard to navigate through these time periods. But, I think what it does show, Michael, is that, Jim Collins wrote a book, Good to Great, which is a fantastic book. So anyone that's into business should read that. And he talks about a concept of return on luck. So the good companies, the great companies had a strong return on luck, which means that when an opportunity arose, they would make sure they've got the systems and process to identify those opportunities and make the most of them. And when I look back, over the last couple of years, in 21, I wrote a blog about holding costs for property have never been this low. At the time, you could borrow on a fixed rate for almost 2-ish%, sometimes less than 2%, fixed for 3 years. And the holding costs were minimal. You could go and buy a $1 or $2 million property, investment property, and, compared to, historic averages, tiny sort of outflow. For the people that took that opportunity, and I would imagine a lot of people sort of stood on the sidelines and didn't, but for the people that grasped that opportunity, they got into the market, they were able to extend their borrowing capacity maybe a little bit more than what it usually would have been, of course, as long as it was appropriate for them from a cash flow perspective. And they would have got into the market, and that would have been their starting point. And they would have enjoyed 3 years of really cheap holding costs, which might have come off this year and sort of normalised. And I'm not suggesting that we should kind of arbitrage a market or just look for those opportunities, but it is a bit of return on luck. Maybe that's what 2024 can kind of teach us is I think 10% of the time property investing is just being in the right place at the right time. But you've got to be
recognizing it, Stuart. That's the difference.
I was going to say, you've got to be able to see it, right? So if I'm not at that auction, when for whatever reason it's a fantastic property but no one else is bidding, if I'm still sitting at home on my couch, I'm never going to see it, right? If I'm not following the market, if I'm not understanding trends and listening to podcasts, that I might not see it. And I guess for those people that are listening that look back over the last few years and ask yourself this year, what can you learn? I think that's one of the return on luck concept. I think is now luck shouldn't be a necessary ingredient to make your investment strategy work. Of course, luck is random, but I think property investing is 10% luck on the day.
I'm not sure that luck is random. There is random luck, no doubt about that, like winning the lottery but I think a large part of success in property, in business, in relationships, in life is actually creating your own luck by having a positive outlook, by educating yourself, by understanding what's going on, by dealing with the right people, by being in the right circles. And then, as you said, recognizing when the opportunities are there. So I think successful people in general, as well as investors, make their own luck. So random luck's out of your control, but forced created luck, I think, is in your control. So that's a really, really good lesson for 2024. Looking forward into 2025, I know we said predictions are hard to make, especially about the future, but what are your thoughts about 2025?
Well, we'll probably have a federal election in 25, of course. So I think that's going to be kind of interesting.
Hang on, not probably. That'll be my first prediction. We're going to have one.
Yeah, that's right. At least we can nail that one, I guess. That'll be kind of interesting. Property affordability is always a key point, a talking point in federal elections. Unfortunately, it never gets beyond just a talking point. No one actually does anything about it. But no, I don't think the government's really that interested in finding a solution because, as we've spoken before on this podcast, Michael, the government enjoys substantial tax revenue, both federal and state governments, from the fact that property prices keep appreciating. So, and they're probably one of the biggest contributors in terms of tax as well. So let's not fool ourselves. The politicians don't want to solve the problem, but it will be a talking point. And it'll be kind of interesting to see what happens there. I think one of the key things that property investors should look out for is a potential change in fiscal policy. So, I mean, the RBA has been talking about it a lot, talking about where the underlying growth in the economy, particularly from employment growth as well, all coming from the public sector. The private sector is a lot weaker than it was at the beginning of the year. So the interest rate hikes have done their work there. But, the government spending is really what's sort of, I guess, contributing towards inflation. And I think that'll be a key point too as well. I mean, I'd imagine the Albanese government would like to go into a election with the backdrop of falling interest rates. The RBA's said very clearly they want to see at least a couple of quarters of lower inflation, which means that at best we're likely to get an interest rate cut in May, but very unlikely to get one before May, which means they'll go into an election with interest rates unchanged. And so as a property investor, what I'm looking to see or wanting to get a sense of is when will interest rates change and what needs to change for them to change, which obviously is that public spending element. The other thing that could come out of the federal election is that if the Dutton government wins, maybe there might be at least a change in sentiment in Victoria as well. Now, of course, Victoria is the second largest economy in Australia, certainly not on a per capita basis, unfortunately, but just as an aggregate situation. And so I think markets tend to be very forward-looking. We know that. So we don't actually need to see changes like a change in government or a tax cut or removal of the land tax levy or any of those. I mean, that'd be nice, but markets don't typically need to see that happen. They just need to anticipate better news on the horizon. So if the coalition win the federal election next year, it might have positive side effects for the Victorian economy and therefore the Victorian property market as well.
Interesting. So we'll be speaking regularly on the Michael Yardney podcast to see how all that transpires. There's a couple more things I want to ask you, but I just mentioned that we'll be speaking regularly on the Michael Yardney podcast. I'd also like to say that I enjoy your Wednesday podcast, Investopoly, and your blog, and I'll leave a link in the show notes. I do want to ask you a few more questions about 2025, but what you're clearly showing in your discussion is the depth of your knowledge and why I love having a chat with you about property. And your team at Pro Solution, actually a multifaceted company, which I think gives you the information to be able to discuss this. Maybe you can quickly explain what you do before we talk a bit more about 2025.
Yeah, most financial services firms are quite siloed. You know, you've got an accounting team and a financial planning team and so on. We want to break down those silos and not really define ourselves by, our background or, the particular job that we're doing. Ultimately, at the end of the day, we want to help our clients build wealth. That's what most of our clients are sort of focused on. And the other thing as well is we want to be asset class agnostic. So, it's not about shares, it's not about super, it's not just about property. It's really ultimately, again, at the end of the day, about wealth. And we feel like most people would be better off or well placed to invest in both of those key asset classes, but we don't have a preconceived idea. So it's really just about working with clients, developing a tailored solution, helping them implement it over, many, many years.
Well, I'll leave a link to Pro Solutions in the show notes, but basically you provide accounting, financial planning and finance services. And so you actually, as you say, because you're not buyer's agents and you're not share brokers, and I know you've got a financial planning arm as well, though, basically you can give the right advice to clients, but you've done it for a long time and that's giving you great perspective. So let's pull out the crystal ball, polish it up. We've kept hovering around the outskirts of it. What's going to happen to interest rates next year? What do you think that's going to, how do you think that's going to pan out?
Look, it's funny. We've gone through a period of really low interest rates. Even pre-COVID, interest rates were, below the long-term average. And, you might describe current interest rate settings as high. And certainly that's true if you just look over the last 10 years or even the last 15 years, they are relatively high. But if you take a longer term view than that, they're maybe not as high as we might initially think, And I always advise people, I have done for many years, use an interest rate of 6.5%. When you're doing your numbers and doing your planning, use interest rate at 6.5%. Sometimes it will be above that, sometimes it will be below that. But I think if you can afford it at that level, you'll probably be able to ride out a little bit of volatility in terms of interest rates. So whilst we look at rates today and we go, okay, well, they're high sixes or maybe even into the sevens, I don't think we can sit back as investors. We can hope that they're going to fall substantially, but I don't think our investment strategy should be based upon it. I think we might see some interest rate cuts next year, but it's all data dependent. Of course, it's going to a little bit depend on what's going on in the US as well. And then also what happens with the federal election, which I just spoke about, and its impact on public spending as well. So maybe we'll see maybe one or two cuts in the second half of next year, but I don't think it's going to be that material. It's not really going to change your cash flow position all that much, and it's not really going to change borrowing capacity all that much either. So I don't think interest rates or changes in interest rates are going to be a major factor in 2025, except to say that at least, I guess, it gives us confidence, investors confidence, that interest rates are heading in the right direction, either stable or reducing. And we'll just have to see what happens with inflation, whether it can get knocked on the head. And the big question is whether it will reemerge, whether it will tick back up again. Again, depends on, it depends a lot on government policy.
If you've been in the property markets for a while, you'll recognise that currently interest rates are the sort of rates we would have loved to have 15, 20 years ago. For the decade before COVID, interest rates were low, as you said. Most people don't recognise the reason they were low was the Reserve Bank was having difficulty getting inflation up to its range of 1% to 2%. So they were on purpose low to encourage growth. I can see interest rates dropping a bit, probably not in the first half of next year, 2025, and maybe 2, 3, 4 0.25% interest rate cuts. So we may drop 1% or so the official rate, maybe 1.5% if we're lucky. But I agree with you. I don't see significant drops. And again, if you factor that into the planning that you've got, if interest rates fall lower, well, you're ahead, aren't you?
Yeah, it's just icing on the cake, but you shouldn't be premised on that. Of course, we've got to shop around. There's no point paying any more than you need to.
Yeah.
So I think any proactive investor that's listening to this podcast would know that getting in contact with your mortgage broker every 6-12 months, making sure you've got the right discounts in place is key, and that's probably where you're going to get most of your saving, rather than necessarily waiting for the RBA to sort of tap you on the
Yeah.
shoulder and pass on a rate cut.
So do you see any particular risks or pitfalls investors should watch out for in 2025, Stuart?
Look, I think one thing you mentioned, Michael, which is really important, is sometimes data can fulfill or prove an incorrect thesis. So one of the problems in a market that's fast moving, and particularly in a market that might be driven by interstate investors, is that it can skew property prices, and particularly property prices in a particular geographical location as well. And you sort of spoke about it, Michael, about say buyers agents from the East Coast moving over to the West Coast, for example, and starting to buy property in Perth, whether they have people on the ground or maybe that's sight unseen. But we all know stories of agencies getting really active in a particular location. And then, of course, because they're providing most of the demand, and in order to secure the sale from the person in Perth that's willing to sell their property, they need to continually achieve a higher price point. So then the challenge then becomes, or the risk, I think probably more correctly, then becomes for the uninitiated investor, is that a buyer's agent might go, look, we've been buying in this location, prices have increased 30% over the last 2 years. This is a great investment location. And that's risky, right? Because, of course, if that agency has been one of the key contributors to that growth, it's kind of artificial, or at least you'd argue it's artificial, and it feels really risky. And we've spoken about many times before, really, if I'm going to choose a buyer's agent, personally, if I'm going to go and find a buyer's agent, I want them to be an expert in that geographical location. They need to be on the ground, hopefully
Yes.
living in that location, that state. And that's what I'm paying them for, is that experience. They've seen the market in many different cycles. They've seen that, this street performs, this street, for whatever reason, just doesn't perform or underperforms. And that's what I'm really paying for. I'm not paying for someone to do, run some reports off RP data and do some financial analysis, or, strike an agreement with a local real estate agent or something like that. And that's being sold a product rather than getting advice. And I think people need to be really careful about that. Particularly, it happens in every market where there's a buoyant market. So,
Well, it's not just the West Coast. I'm seeing it in regional Queensland. Up north, Townsville's a good example. There's a number of others as well, where there's a couple of very active buyers agencies who proudly say we buy 50 properties a month. Hey, I can't find 50 properties a month in the city of Sydney or Melbourne that I'd recommend to clients. So, yes, they're pushing up prices, and it's almost a self-fulfilling prophecy. But was it Warren Buffett who said a rising tide lifts all ships, but when the tide goes out, you see who's swimming naked?
yeah, that's right. And I think it's a really, asset selection, and we speak about it. It comes up in almost every episode we do together, and a lot of episodes that I'm not in, is that asset selection is key. If you can buy the right asset, then you can improve that asset or manage that asset as best as you can. That's going to get you a return. But at the end of the day, it's really, where is the land located? How much land do I have? Is it in a scarce, highly desirable location? That you cannot change after you purchase it. So
No.
therefore, that's the key decision, to make sure that 13 Smith Street is actually the best asset you can buy in your budget. And it's absolutely critical that you don't get drawn along with the hype, that you deal with a person, a firm that has decades of experience in that local market. And that's the best way. It's not a magic bullet, but it's the best way to eliminate the risk, or at least minimize the risk of ending up with an asset that's not going to perform for you.
Well, I guess one of the forecasts for 2025 is going to be that some property investors are going to make the wrong decision. It's just the way history's always been, that 50% of property investors in general sell up in the first 5 years. In fact, the CoreLogic Pain and Gain report would suggest they're selling up even quicker. So be careful who you get advice from. Stuart, thank you very much. To finish off, is there maybe a sentence you could sum up 2024 with from a property perspective?
Yeah, make good long-term decisions. Forget about all the noise. That's two sentences, actually. But,
With a
as we
comma,
said,
one sentence with a comma in the middle.
yeah, that's right. I mean, one thing we spoke about at the beginning, Michael, was that, there's a lot of commentary out there. A lot of things can change. So much has happened over the last 5 calendar years, particularly in property markets and differences in different property markets. Probably I can't really think of a time. You always have one market that's doing better than the other, but there's such a stark difference between many markets. It's kind of a unique situation. But really, it all comes back to making the best long-term decision. The best thing with that, with property, is it forces you to focus on the fundamentals. Someone might dangle the carrot of, here's what's happened over the last 2 or 5 years. But really, if I'm going to hold this property for 20 years or hopefully even longer than that, then I've got to be really thinking about, what will that asset be worth in 20 years? Does it make sense? Does it have the fundamentals to continually push a high average growth rate over that 20-year period? Or am I buying an asset that's popular today, that might enjoy a little bit of growth over the next couple of years, but then will just be average in terms of long-term return, which isn't going to work from an investment perspective. So really, I think drown out the noise, make some good long-term decisions. I think that's the key thing that 2024 has taught us yet again.
Fantastic advice to finish off with. And Stuart, I wish you and your family a fantastic festive season, and I look forward to catching up with you regularly on the Michael Yardney Podcast in 2025.
Thanks, Michael. It's been fun, and thank you to everyone listening.
Stuart always brings great information to these podcasts, doesn't he? And I hope the message you got was that despite all the mixed messages in the media, despite a lot of people feeling uncertain about what's happening, the fundamentals for property for 2025 are sound, and there's good opportunities for those who are in the right financial position to take advantage of them. Now, I don't know your personal financial position, and that's why I can't give you any advice. What I do know is a lot of people finish 2024 disappointed that they didn't take advantage of the market because there was all this information they got on the media, too many opinions, too little clarity. They were worried about making a mistake. There was issues about mortgage crisis and all those cliffs that we never fell off. So why not get some clarity, have a clear plan? The solution to wealth is to start with a plan and then implement the plan. And that's what we help our clients do at Metropole. We're much more than buyers agents. We help our clients safely grow, protect and outperform the markets and pass on their wealth by starting with strategic property and wealth advice. We help you define your goals, make sure they're realistic, and then we use very powerful software that you have access to track your progress, to maximize your wealth creation opportunities, but also identify and mitigate risks. So a property strategist's job is to stop you making mistakes. So we're much more than buyers agents. We have a very significant buyers agency department, and we're happy to manage your property in the long term. We'll help you accumulate your wealth. But first of all, we've got to help you plan to become the person you plan to become. So why not go to metropole.com.au and have a complimentary wealth discovery chat with one of our property wealth strategists, metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to discuss with you one of the big differences between winners and losers. Look, over the years, I've had the privilege of working with thousands of property investors, business people, entrepreneurs, and I've met so many very successful people and some who are not as successful. And in general, I found those people fall into two groups: the ones that make excuses and the ones that don't. The ones that make excuses, I don't think they start off life that way. No one's born talented at making excuses, but over the years they've learned to get out of things. They've learned how to blame the economy, their parents, their teachers, the government, the banks, the system, pretty much anything to deflect blame away from themselves. This gives them the excuse they need. Then, of course, there's the other group of people, those who don't make excuses, or rather won't. Look, we've all got our difficulties, we've all got our challenges, and some days we feel like making excuses. But winners stop themselves. They don't make excuses. They just get on with the job. Interestingly, I believe we've all got similar capabilities. We've got the similar capabilities to get things done or not, to do things or to make excuses. So when you get up in the morning, you get the choice which route you take. I recently read this insightful quote. The difference between successful people and unsuccessful people is that smart people hate doing what unsuccessful people hate doing, but the successful people, they just do it anyway. That's right. Successful people hate doing the same things that unsuccessful people dislike doing, but they do them anyway. I've said it before. Do the hard things now and you're going to get an easy life later. Do the easy things now and you're going to have a harder life later. So as you go through this journey that we call life, you'll have a chance to do things or back out. The choice is yours. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?